Welcome to our webinar on the Small Business Healthcare Tax Credit. I am Lillian Shapiro of HR Benefits 360, your moderator. We're going to start talking right now with Sarah Sclafani, one of the attorneys on the HR and Benefits Library editorial team, to discuss the Small Business Healthcare Tax Credit. So Sarah, what is the Small Business Healthcare Tax Credit?
The Small Business Healthcare Tax Credit, which is set forth in 26 U.S.C. Section 45R, was established to assist small businesses and small tax-exempt organizations pay the cost of providing health coverage to their employees, and it's specifically targeted for those with low and moderate income workers. The credit is designed to encourage small employers to offer health coverage for the first time or maintain coverage they already have. In general, the credit is available to small employers that pay at least half the cost of single coverage for their employees.
Okay, now let's start off by talking about some basic rules for being eligible for the Small Business Healthcare Tax Credit. Who is an eligible employer for the Healthcare Tax Credit?
In order to be an eligible small employer, an employer must meet three main criteria. First, the employer must have fewer than 25 full-time equivalent employees, FTEs, for the taxable year. Second, the average annual wages of its employees for the year must be less than $50,000 per FTE. And third, the employer must maintain a qualifying arrangement. A qualifying arrangement is an arrangement under which the employer pays premiums for each employee enrolled in health coverage offered by the employer in an amount equal to a uniform percentage, not less than 50% of the premium cost of the coverage. An employer that is an agency or instrumentality of the federal government, or a state, local, or Indian tribal government, is not an eligible small employer for purposes of Section 45R unless it is an organization described in Section 501C of the Internal Revenue Code that is exempt from tax under Section 501A.
So let's turn to the next slide, Sarah. What would be the steps necessary to determining whether an employer is eligible for a tax credit?
The following steps must be followed to determine whether an employer is eligible for a tax credit under Section 45R. 1. Determine the employees who are taken into account for purposes of the credit. 2. Determine the number of hours of service performed by those employees. 3. Calculate the number of the employer's FTEs. 4. Determine the average annual wages paid per FTE. 5. Determine the premiums paid by the employer that are taken into account for purposes of the credit. Specifically, the premiums must be paid by an employer under a qualifying arrangement and must be paid for health insurance that meets the requirements of Section 45R.
Okay, Sarah, now you said that in general, the credit is available to small employers that pay at least half the cost of single coverage for their employees. How do the qualifying arrangement rules apply to family coverage in 2010?
According to the IRS, the requirement that the employer pay at least 50% of the premium for an employee applies to the premium for single or employee-only coverage for the employee. Therefore, if the employee is receiving single coverage, the employer satisfies the 50% requirement for each employee if it pays at least 50% of the premium for that coverage for each employee receiving single coverage. If the employee is receiving coverage that is more expensive than single coverage, such as family or self-plus-one coverage, the employer satisfies the 50% requirement for that employee if the employer pays an amount of the premium that is at least 50% of the premium for single coverage for that employee, even if it is less than 50% of the premium for the coverage the employee is actually receiving.
Now, here's an interesting question. May tax-exempt organizations be eligible for the tax credit?
Yes. Qualified employers include an organization described in Section 501C of the Internal Revenue Code that is exempt from tax under Section 501A.
Now let's talk about some of the questions relating to the amount of the credit. What is the maximum healthcare tax credit available to employers?
For tax years 2010 through 2013, the maximum credit is 35% of the employer's premium expenses that count towards the credit. The credit is worth up to 25% of premiums paid by eligible tax-exempt organizations. In 2014, the maximum credit increases to 50% for small businesses and 35% for tax-exempt employers. For tax years 2010 through 2013, the amount of the credit is based on a percentage of the lesser of the amount of non-elective contributions paid by the eligible small employer on behalf of employees under the arrangement during the taxable year, and the amount of non-elective contributions the employer would have paid under the arrangement if such employee were enrolled in a plan that had a premium equal to the average premium for the small group market in the state, or in an area in the state in which the employer is offering health insurance coverage.
Okay, that's great. Let's turn to the next slide, which provides us with a convenient chart of average state premiums.
The U.S. Department of Health and Human Services has developed a chart that sets the average premium for the small group market in each state for the 2010 tax year. The chart provides the average premiums based on employee-only coverage and family coverage. The chart is available in IRS Revenue Ruling 2010-13.
Now, as you can see on the slide, we also give a website address for the chart, and it's very handy and easy to access and really gives the information that you're looking for when it comes to the average premiums for the small group market in each state. Now, Sarah, can you give us an example of how the premiums are counted for the purposes of the credit?
Yes, let's start with a generic example of how premiums are counted for purposes of the credit. If an eligible small employer pays 80% of the premiums for coverage provided to employees, and employees pay the other 20%, the premiums taken into account for purposes of the credit are the lesser of 80% of the total actual premiums paid, or 80% of the premiums that would have been paid for the coverage if the average premium for the small group market in the state, or an area within the state, were substituted for the actual premium.
Now, Sarah, just to take it a bit further, can you break down a few examples of how to calculate the amount of premium related to the credit?
Sure. Now let's look at two examples that illustrate how to determine the amount of premium payments for purposes of the credit. Example 1. An eligible small employer offers a health insurance plan with single and family coverage. Employer has 9 FTEs with average annual wages of $23,000 per FTE. 4 employees are enrolled in single coverage and 5 are enrolled in family coverage. The employer pays 50% of the premiums for all employees enrolled in single coverage and 50% of the premiums for all employees enrolled in family coverage, and the employee is responsible for the remainder in each case. The premiums are $4,000 a year for single coverage and $10,000 a year for family coverage. The average premium for the small group market in employer's state is $5,000 for single coverage and $12,000 for family coverage. The employer's premium payments for each FTE, $2,000 for single coverage and $5,000 for family coverage, do not exceed 50% of the average premium for the small group market in employer's state, $2,500 for single coverage and $6,000 for family coverage. Thus, the amount of premiums paid by the employer for purposes of computing the credit equals $33,000. 4 times $2,000 plus 5 times $5,000.
That's great, Sarah. Now I want to take a quick look at what happens in terms of premium contribution, which exceeds the state average.
Great. Now let's look at example 2, in which an employer's premium payments exceed the average premium for a small group market. We have the same facts as example 1, except that the premiums are $6,000 for single coverage and $14,000 for family coverage. The employer's premium payments for each employee, $3,000 for single coverage and $7,000 for family coverage, exceed 50% of the average premium for the small group market in the employer's state, $2,500 for single coverage and $6,000 for family coverage. Thus, the amount of premiums paid by the employer for purposes of computing the credit equals $40,000, 4 times $2,500 plus 5 times $6,000.
Under what circumstances would an employer receive less than the maximum credit?
An eligible small employer's credit is reduced if the employer's number of full-time equivalent employees, or FTEs, exceeds 10, or the employer's average annual wages exceed $25,000.
Now, Sarah, how would you calculate the reduction in credit?
If an employer's number of FTEs exceeds 10, the reduction in the credit is determined by multiplying the otherwise applicable credit amount by a fraction. The numerator of this fraction is the number of FTEs in excess of 10, and the denominator is 15. If an employer's average annual wages exceed $25,000, the reduction in the credit is determined by multiplying the otherwise applicable credit amount by a fraction. The numerator of this fraction is the amount by which average annual wages exceed $25,000, and the denominator is $25,000. In both cases, the result of the calculation is subtracted from the otherwise applicable credit to determine the credit to which the employer is entitled. For an employer with both more than 10 FTEs and average annual wages exceeding $25,000, the reduction is the sum of the amount of the two reductions. This sum may reduce the credit to zero for some employers with fewer than 25 FTEs and average annual wages of less than $50,000.
So Sarah, what is the maximum credit available to tax-exempt employers?
For tax years 2010 through 2013, the maximum credit for a tax-exempt qualified employer is 25% of the employer's premium expenses that count towards the credit, which we will describe next. However, the amount of the credit cannot exceed the total amount of income and Medicare, i.e. hospital insurance tax, the employer is required to withhold from employees' wages for the year, and the employer's share of Medicare tax on employees' wages for the year.
Okay, that makes a lot of sense. What health costs are considered in calculating the credit?
The IRS notes that only premiums paid by the employer under a qualifying arrangement are counted in calculating the credit. Under the qualifying arrangement, the employer pays premiums for each employee enrolled in health care coverage offered by the employer in an amount equal to a uniform percentage, not less than 50% of the premium cost of the coverage.
Sarah, please tell us more about the health insurer and health insurance coverage aspects of the credit.
For years 2010 through 2013, only premiums paid to a health insurance issuer for health care coverage are counted for purposes of the credit. For example, a health insurance issuer would include an insurance company or HMO. For years 2010 through 2013, health coverage for purposes of the credit means benefits consisting of medical care, provided directly through insurance or reimbursement or otherwise, under any hospital or medical service policy or certificate, hospital or medical service plan contract, or HMO contract offered by a health insurance issuer. Health insurance coverage for purposes of the tax credit also includes the following plans: limited scope dental or vision, long-term care, nursing home care, home health care, community-based care, or any combination thereof, coverage only for a specified disease or illness, hospital indemnity or other fixed indemnity coverage, and Medicare supplemental health coverage, certain other supplemental coverage, and similar supplemental coverage provided to employees under a group health plan. However, if an employer offers more than one type of coverage, the employer must separately satisfy the requirements for a qualifying arrangement for each type of coverage the employer offers. An example of more than one type of coverage would be a major medical plan and a separate limited scope dental or vision plan.